What's up, and welcome to another episode of Learning Financial Basics. My name's Scott, and I'm here to make sure you get the most out of your money. Today's episode is going to be an amalgamation of a bunch of different concepts I wanted to dole out over a bunch of different episodes. However, desperate times call for desperate measures. Today's video is how to survive a stock market crash. Let's get into it. The past 3 weeks have been an absolute disaster for investors. Thanks to the spread of COVID-19 and the race to the bottom for fuel producers, the 1-2 punch has been too much for all stock markets to take. Top stocks and all indexes have fallen between 20 and 30% off their current highs, and an overall panic has seized the market. Now, since this chaos has ensued, I've been getting a lot of texts and calls and messages from family and friends talking about their situation and saying a lot of different things, but one real theme that has emerged is the question, straight up, is this a good time to invest money? Now, as I'm going to talk about in this video, that's a really loaded question. And in my opinion, it has a lot more to do with your financial situation as an individual and your personal situation than it does what point we are at on an index chart. So let's get into if this is a good time to invest and how to protect yourself. First, let's do a little history lesson. The last time we saw this much market volatility was back during the famous banking crash of 2008. Back in 2008, all major stock markets crashed due to questionable loans and a lot of financial institutions doing things that have since very much been outlawed. Now, when the crash started, the Toronto Stock Exchange, the TSX here in Canada, was hovering between 14 and 15,000 points. Fast forward a few months and we were all the way down to 7,000. Now that gives you an idea of just how bad some of these stock market crashes can go. You might be thinking, the current 2020 crash, that must be pretty close at this point, right? Everyone's panicking? Well, we've only really dropped down to between 12 and 13,000 points. So what I'm trying to say is, although the media is right, there's been big crash numbers, this could get a whole lot worse. With that in mind, let's talk about the actual goal of investing. Now, it's said that in times of strife, such as this, it becomes very evident who's a day trader and who is investing. Now, day traders are people who buy shares and are looking to offload them within 24, 48, 72 hours. They're looking to flip them for a profit. It's called timing the market, and it is incredibly hard to do. You must be very skilled, highly trained, and very lucky. And for the average human being, it is impossible to do consistently. Investors are looking at long-term growth, have a long-term plan, and are essentially okay with the idea of locking up their money now for returns down the road. Those are two very different things. And when we're going to talk about if it's a good market to invest in, it's important that you realize whether you're trying to day trade or invest. So if you've decided you're a day trader, good luck. You can certainly still use these tips that I'll be giving, but they are mostly focused on people who are looking at locking up long-term growth. Now, the tips to start investing are actually quite basic, but they're incredibly important. The number one tip that I would give is you really have to give some thought to your situation and prepare before you even really start looking at stocks, bonds, and mutual funds. What I mean by this is an investor who has a nest egg and is protected before they get into the market are so much likely to actually see profits down the road and not be drawn to knee-jerk reactions based on financial needs that are immediate. So, for example, if you put aside 3 to 6 months expenditures and you feel relatively safe at your job, you're much more likely to be able to take downturns like this current market crash we're in stride. On the flip side, if you only have a few $100s lying around and no nest egg, when the market crashes 20 or 30%, you immediately are going to start going into preservation mode and start thinking, I need that money. I mean, I know I'm gonna lose 35–40% of it if I take it out now, but I need it so I can make rent next month. Those are the two different mindsets that you can be in, and one of them is going to cause you to think about pulling your money out as soon as you see red, which will happen, where the other mindset allows you to go to sleep every night knowing that no matter what happens when you wake up, you're gonna be fine, and that your money is meant for future you, not current you. So with that being said, I hope that you already are in a position where you have enough cash on hand to protect you in the upcoming days and months and maybe year, so that you really can look at your stock portfolio as kind of a last resort. It would be a shame to sell a bunch of shares in high quality companies or mutual fund shares now when in a year or 2 or 3, they could be worth so much more than they're currently trading at. Now, we don't know what's gonna happen in this current market. This is the first time where there's been this really massive decline based on something as unknown as COVID-19. But what we do have is history. So using the 2008 market crash as an example, selling now is not an option if you're looking at making long-term profits off your current shares. This comes back to the idea of how much you need the money and if you're willing to take the risk. So getting to the question that everyone's been asking me, do I think this is a good time to invest money? So if you've gone through the checklist and made sure you're set with cash for the future, you feel comfortable in your position at work because the market is crashing, it is potentially a good time to buy, but that means you also need to think about how this is going to implicate your work, your profession. Companies may be scaling back their marketing with their share prices going down. They might be in cash crunches. Layoffs may happen. These are all things you do have to consider before you go throwing your money into the market. Now, if you've gone through your list, you're confident, you said, Scott, I hear the warnings, but I've been saving this chunk of money for long-term growth, and I think now might be a good time. If that's the case, there's an approach that I really like called the 1/3 approach. Now, what this approach is actually pretty simple. It's based on the concept that no matter how hard you try, you're most likely not going to time the market correctly and actually put your money in at the bottom of this stock market decline. So to hedge your bets against this, if you divide the cash you have for investing into 3 equal parts, you can add money, say next week, if you really think that this is as bad as it's gonna get. Now, maybe the market goes up, you look like a genius, that's great. You could turn around and the market could decline another 15%. Now, because you didn't jump into the deep end and put all your money in, you still have 2/3 of the money left. So what you can do at this point is put another third of your money in at a much cheaper rate than it was just a week or 2 or a month before, and wait it out. Now, if the market goes up, once again, you look smart. Look, you caught the bottom. But maybe you turn around and it drops another 15% that week. We'll be in pretty dire straits now, but you still have 1 bullet left in your chamber, and at this point you can put the 1/3 amount of your money in. Where you started up here, which you thought was the bottom, and where the real bottom might have been here, it could still go lower, you have averaged out your shares over time to really try to maximize the volatility in the market. Now, this is my fail-safe approach to try to deal with the volatility, because as I've said again and again, no one knows where this particular market is going. And if they say they do, they're lying to you. Now, even if you're using the 1/3 process, I really have to emphasize, you have to be okay with the potential that you could be looking at half the money you invested in as little as a day, a week, a month. We're in really volatile times right now. So it's all about mindset. And I want to emphasize, if you think you're going into this and within a month or 2 or even 3 you'll be making tons of money, there's a small chance that happens, but it's actually more likely that you're going to have to deal with relatively heavy losses over time as the market recovers. When the crash happened in 2008, it took up to about 2014 for anyone to actually really be making money. You were breaking even between 2011, 2012, and 13. So I just want to emphasize that if you are hopping into the market, you really do have to be okay with the fact that you're not selling these shares anytime soon, and it may take literal years for you to see the benefits of acting on these volatile markets. Doesn't mean you shouldn't take advantage of them, you just have to go into them with that very set mindset. One last thing I want to touch on in this episode is actually my favorite function of investing, and it is the almighty dividend. Now, a dividend is essentially an agreement that a company makes with you, the shareholder, that as long as you hold their shares, they will actually pay you money for doing so. Traditionally, this is paid out 4 times a year in quarterly dividend payments. That's not the case for all companies. Some do as much as monthly dividends, but standard is once a quarter. Now, why this is important in volatile markets like what we're experiencing right now is there is a huge difference between someone who has a portfolio just full of speculative stocks that pay no dividends and someone who has put together a portfolio where they get paid money 4 times a year. This won't necessarily mean that you're going to be making money in a bear market like what we may be experiencing for the next few months or years, but it does mean that your portfolio would look significantly better than someone whose was all speculative, no fixed income. So I just want to get that in your head as you start building a potential watch list of companies that you're thinking about investing in. In these type of really unpredictable markets, you want to make sure that you're only going after absolute blue chip proven companies who are industry leaders. You most likely want to target things like banks and telecoms and really rely on that heavy dividend payout to be kind of a defense mechanism against the unpredictability that is about to come. Well, that's it for today's video. I hope it helped. I know the world is pretty crazy out there right now, and I know nothing about medical science, but I do know a little bit about money. So I wanted to put out a video to kind of help answer some questions, as there are a lot of them creeping up with this pretty insane market volatility. If history is any indication, hopefully if you're able to hold strong and not panic sell, hopefully everything will work out well for everyone. Now, I do videos as often as I can here about financial literacy and tips and tricks to help you make the most of your money. And my real goal is just to educate everyone and make sure that they have as much knowledge as they can when dealing with their day-to-day financial situation. If you like today's video, make sure to like and subscribe, hit the bell, and you'll be notified when my next video comes out. Be safe out there, everyone.